All right, Channing, we are live and our participants are starting to spill in. I don't know what you said or did here, Channing, but this is the highest, the most attended webinar we've done in 13 months. So you must be one heck of a draw.
Sounds good. I think it's the topic. The topic is, I think, a super relevant topic today.
Yeah, so good afternoon to our friends here on the East Coast and good morning to the rest of the country. I'm here with my colleague and friend, Channing Schmidt. Channing is the Advanced Markets Director at Securian. You may know them as Minnesota Life. He's a JD and a CFP, published author, speaker. But I would say where Channing really separates himself, in particular in this subject, is that he's built an entire catalog of planning ideas with technology support in a series called LIFT, which is a life insurance as a financial tool, which teaches financial professionals how to understand different life insurance strategies as clients approach different stages of their lives. And one stage of their life, actually, what we're going to talk about today is IRA planning. So the purpose of this presentation is really twofold, and you're going to see a bunch of different notes. One is as an informational piece, reference piece, where we're going to send you copies of the slides. If you want to get technical and granular, all the data is there for you. But really, for today's purposes, we want to hit the fun stuff. We were going to go fast on the technical stuff. We're going to go slow on the things that we think you really need to know. And then where does life insurance fit in? We're talking about a lot of different solutions, but really focus on life insurance, and absent of skipping over the other relevant planning tools, we're just going to give those to you in the form of a slide deck. So we'll start off doing a little bit of setup, because you can't really understand the destination until you understand how we got here. So Secure Act 1.0 was the starting point. And every wealthy individual who had meaningful dollars in their IRA did two simple things. One was they stretched their IRA, and two, they left their IRA assets to a trust. So the stretch IRA is not a type of IRA, it's just a financial strategy that extends the deferral period and it gets around this RMD issue. Channing, you want to comment on the RMD and the stretch IRA and the benefits that clients used to see in using this strategy?
Yeah, like you said, Anthony, it was a way that they could stretch. If the IRA went over to the beneficiary, they could stretch it out over that beneficiary's lifetime. And so I know we have some examples coming up, and it could be very powerful planning technique if they kind of kept it there. Because one thing about IRAs is it's a really great retirement income tool, because we're using before tax dollars. But the things that clients have to remember is that when they take it out, they're going to have to pay taxes. And a lot of clients want to make sure we can do this the most efficient way possible. And the stretch IRA, when that goes to a beneficiary, where we used to be able to stretch it out, but here Secure Act kind of changed that.
Yeah, so in layman terms, like, you're going to get a bunch of different tax perks in depositing money into qualified plans, and a lot of different deferral perks. But as they say, the chickens have to come home to roost, Channing. Like, the government's going to get their money at some time, right? So it's a matter of how quickly. If in this example you're looking at on $1 million IRA balance divided by a life expectancy of 20 years, the government's going to force you to pull $49,000 out of your IRA in that given year. Now, if you stretched it and you named a younger beneficiary as the recipient of your inherited IRA, and that beneficiary had a 50-year life expectancy, well, guess what? You get to enjoy the continuation of that tax deferral, and you stretch that $1 million into $20,000 distributions each year that the IRS requires you to take. So you get to hang on and ride out that tax deferral compound interest train for a much longer duration. So I will say, everyone talked about it, but no one really even used it. So, when it gets into the Secure Act 1.0, this was essentially the demise of the stretch IRA and the demise of leaving those assets to a conduit or a discretionary trust. And in our opinion, moves life insurance to the very top of the planning list. So, Channing, give us just a quick setup on how the Secure Act 1.0 killed the stretch, and then what the rules are in this infamous 10-year rule, which no one seems to understand. So we're going to cover it today very quickly.
Yeah, sounds good. So this was a big change to a lot of the planning. And for the most part, there's some good things in Secure Act 1.0, but this was the thing that really got everybody's attention. And sometimes you don't know what you got until it's gone. And that's true, because we always talked about the stretch IRA, Anthony. I think you hit on that. But now that it's gone, at least for some of the beneficiaries, it's really there. I think some of it is the government sees all this money that people are putting away in their qualified plans, and they know that we're running into different deficits that are coming up. And so a lot of revenue, they're looking to get some places for revenue, and this could be a source of it. And so this was a big change on this. So no longer were we able to stretch it out during the beneficiary's lifetime. Now they replaced it with a 10-year payout for all beneficiaries. There are some exceptions to that, which we'll get on the next slide, but this was a big deal because now we're no longer able to stretch those that IRA for those beneficiaries. And instead, we're going to really shorten that time period where they're going to take it out. And it's going to be a 10-year period. And that is a significant change and makes kind of retirement income or these retirement income assets, qualified plans and IRAs, maybe not the best asset to think about as we look at kind of legacy planning and what the client wants to do for their estate plan. So, let's maybe, I think on the next slide, we'll go through those designated beneficiaries, but you're going to see that it's really limited on the ones that will be able to stretch it out.
So picture this, and I might not be so politically correct here. So let's assume I live to a long, healthy life, and my kids are of no longer minors, and they get to grab my IRA as an asset upon my demise. What's going to happen is, and I'll use my son as an example because he's the oldest, little AJ. What's going to happen is, little AJ is going to get 9 years to keep playing this deferral game based on his life expectancy. And then what's going to happen is one of the 80,000 IRS agents that the government just hired is going to walk into his bedroom. He's going to be wearing his inherited IRA pants. They're going to flip him upside down, and they're going to shake every nickel out of his pocket at the end of the 9th year, beginning of the 10th. He's going to have to empty that account and pick up every dollar as ordinary income. So hang on to your wallets here, because the fun is really just beginning. Now, there's some exceptions to this rule, and Channing, these are somewhat common sense. So let's spend a second, because I think it's important to know who doesn't have to play by this 10-year rule.
Yeah. So here's the list that I mentioned before. So going to the surviving spouse, that their person can take it out during their lifetime. Minor children, that was something that caught people's attention, but the thing to watch out for, though, is once they hit age 21, now we've got to hit that 10-year mark. Disabled individuals, that's something that, we look at the definition of what the IRS says on that, same with chronically ill individuals. And then the final one is individuals not more than 10 years younger than the IRA owner. So if you look at this kind of at a bigger picture, they're allowing, at least instead of for minors and disabled and chronically ill individuals, they're allowing that stretch only for people that they think will be a little bit older. The younger ones, that's where you're not able to do that stretch anymore. So if you think about a surviving spouse, they're thinking, okay, this person's going to be maybe close to age to the participant. Same thing with number 5, individuals not more than 10 years younger than the IRA owner. Well, here, once again, they're thinking that participants a little bit older, and so that time frame is truncated. So they're really looking in kind of focusing on when it goes to the kids, that's when the shakedown is going to happen.
Yeah, yeah, yeah. And as my Jewish friends say, Uncle Sam's a real mensch here, right? He's going to let my brother, who's 4 years younger than me, stretch at his life expectancy. It's going to shave him about, I don't know, 3 or 4 lunch, money sessions until he has to empty the account when it's his turn. So yeah, so that's it's important to know. Surviving spouse not applicable. All right, let me give you a quick picture here. So there's a finite date of January 1st, 2020, where this went into effect. And now I'm going to tell you a tale of two grandpas, right? Grandpa has $1 million in his IRA. Grandpa gets all liquored up, has a terrible night, New Year's Eve, 2019, and he drops dead prior to seeing the ball drop. Guess what? He named his 1-year-old grandchild, who had an 80-year life expectancy, as the beneficiary. The stretch kicks in, and a grandson or granddaughter only has to pull down $12,500 in year one, and that'll increase over the next 80 years. But they don't have to deplete that account doesn't run out of steam until the year 2103. Think about that. Now, grandpa number two, he backs off, right? He hits the Prosecco instead of the tequila. He makes it to see the ball drop. January 1st, 2020, he drops dead. 1-year-old grandchild, guess what? Same 12,500 RMD in year one. It increases over the next 9 years. And with 4% growth, they're going to come, one of those 80,000 IRS agents is going to walk into this grandkid's bedroom. He's going to be wearing his inherited IRA pants. He's going to turn them upside down and shake out every nickel worth $1.3 million and recognize that as ordinary income in the year 2030. So this is a huge difference. So January 1st, 2020 is a very important date. I'm going to rip through this as least as rapidly. So this is a terminology where we used to think that you could defer the 9-year period and not have to take any RMDs out during those 9 years. But actually what the IRS is proposed in February 2022 that actually will go into effect says that if an RMD has if a traditional IRA owner began taking RMDs, which means they got to age 70 and a half or 72, whatever the RMD age is, then the beneficiary needs to take them as well. The inherited beneficiary can't be put in the freeze category for that 9-year period like we thought. They have to take RMDs for the 9 years as well. Which accounts are not affected? Let's cover this really quickly, Channing. Who isn't subject to this rule?
Well, the first one is IRA and company plans that are paying lifetime RMDs. Those that are inherited by eligible designated beneficiaries who are receiving the RMDs. Those inherited before the Secure Act and inherited Roth IRAs. I know we'll talk about Roth IRAs a little bit later, but they're not affected by this.
Just key point here, check your beneficiary forms. Even if you have a Roth IRA, if there's no designated beneficiary, there's a 5-year rule that comes into play here. So get your work done.
I would echo that just totally. I think that's something that for financial professionals looking at those beneficiary forms, I think is really important, and making sure that they're filled out the right way. So Anthony, I totally agree with you on that.
Yeah, so this proposed regs were issued in February. So this just further explains if a 75-year-old father leaves his 50-year-old son his IRA and is subject to the 10-year rule, the 50-year-old will also need to take RMDs based on their life expectancy from years 1 to 9 since date of death occurred after dad started taking RMDs. So just a quick point there. IRAs we'll touch on here. No distributions are required until the end of the 10-year term, since death was before the required beginning date, right? And again, what we described was make sure you have your beneficiary forms in place. Otherwise, it's a 5-year rule. So there's a huge Roth IRA advantage here that we'll touch on later in the show. So real quickly, which IRAs you're thinking about your clients? Who am I going to bring this to? you really want to focus on the clients with $1 million in their IRA and up. They're largely affected. Less than $500,000, mostly unaffected. Those folks are going to spend that down. They're going to consume that over their lifetime. Between 500 and $1 million, our industry expert, Ed Slott, he calls this the smash and grab category. This is going to be consumed, and whatever's not consumed, the kids and grandkids are spent that money on the way to the funeral parlor to say their goodbyes to grandma, and really not affected by the 10-year rule. What will be affected are meaningful IRA balances at $1 million and up. That's where you really want to focus. So, Channing, based on your years of experience in seeing thousands of cases come across your desk year over year over year, what do wealthy IRA owners want when it comes to planning as it pertains to their large IRA balances?
They really want control, Anthony. They want to control how that money is being spent. And the one way that they can have that control was naming kind of a trust as a beneficiary. That way they could kind of control how that beneficiary would be able to take money out. But, now that's something we're going to have to take a look at. The biggest thing is number one, post-death control. I've worked with some high net worth clients that, the first thing they want to say is they don't think their kids know how to spend money. They think they're going to blow it right away. And so they want to make sure that they put some rules in there where they can kind of protect it from the grave. And the one way that they could do that was with naming a trust as a beneficiary of it. And the same thing kind of with taxes. We'll go through a little bit, maybe quick, the different types of trusts that were there. But typically what we saw was we don't want to have that money sit within that trust because the trust tax rates are really high. And so, we'd want to make sure that we send that out. There's different instances where we might want to take a look at it. But I think the two top reasons here, as you outlined in the slide, is number one, post-death control, and secondly, kind of lowering the taxes.
Yeah, so if the 10-year rule kicks in and all the money's coming out in year 10,
exactly,
it just doesn't work anymore, right? We might have use a discretionary trust. Maybe you could demonstrate some control over the first 9 years, but then it's game over. The money's coming out to the very people you wanted to protect in the first place, right? Particularly your future ex-son-in-law.
Exactly. You're totally right, Anthony.
So really quick, IRA trust problems. Most larger IRAs were left to trusts. That no longer works. In addition, right, trust tax brackets at $14,450 hit the highest number, 37%. So, the first objective or second objective was minimizing taxes. That kind of blows that story. The first objective in controlling the money and protecting your loved ones is also out the window because of the 10-year rule. So again, these are great reference pieces. You come back to those in the notes when we close out this seminar, but we want to get to the fun part. In Secure Act 2.0, the most important thing here, that there were no game changers. And there's lots of new provisions, but Congress really tipped their hand. Roth options are prevalent. They want immediate revenue. If you think Roth, think good, right? Good terms, good benefits for the Roth. But where the key point here is in 4, which is why we put it in bold and italics. It's not what's new in Secure 2.0. It's what wasn't fixed, which means everything that went into effect in Secure 1.0 is going to be here to stay. It's set. So now we have some clarity around planning opportunities. So again, fast, in Secure 2.0, the RMD age got pushed to age 75. Penalties are a little less. This is a fun one again, right? Again, they tipped their hand. Roth 401k is no longer subject to lifetime RMDs, which is fantastic. A little easier to get access to your money, particularly if you're a public safety employee, right? If you're in a hazardous occupation and you retire early, age 50 or 25 years, you can still access those funds and not pay your 10% penalty. There's some catch-ups that you're going to want to reference. There's some talk about matching 401k contributions for student loan repayments. Everyone, there's a big buzz about, oh, you can roll over your 529 plans to Roths nowadays. Wonderful, but guess what? You're limited to $35,000. So you can't just accumulate like several hundred thousand in your 529 and roll it to a Roth IRA. That's not, Congress isn't that. Uncle Sam's a mensch, but he's not that big of a mensch. So we're looking at expanded Roth, simple and SEPs are now eligible for Roth. Matching contributions can go to the Roth. So you're seeing some similarities here. This one I want to hit fast, but I think you should pay attention. Wealthy clients typically have charitable interests. You can make a direct payment from your IRA to the charity and have a net zero effect. Tax effect. This is important, particularly if you're looking to spend down qualified plan dollars and the client's already charitably inclined. Just a little tweak of how you're directing your cash flows direct from the IRA to the charity make a big difference in planning. There's some auto enrollment. Again, use these as a guide and a reference point. We want to get to the fun stuff. This one, just real quick, you can simulate a stretch when in a special needs situation. So if you're working with a special needs family or client, you can revisit this whole stretch concept and it will work. So it's very, very important. Being that we're in the insurance business, right? And we sell annuity products, there's some good clarification around QLACs. QLACs are qualified longevity annuity contracts. You're allowed to put up to $200,000 a year. This is a fixed annuity. It's back end, almost like a deferred income annuity, which is exactly a deferred income annuity that reduces the RMD formula. If you have $1 million balance, now your balance for calculation purposes is $800,000, avoids RMDs, and it gives you some peace of mind that if you live out to age 85, some additional income will be kicked in. You can also utilize some different SPIA or lifetime income riders. People do want guaranteed income. One of our sales ideas is going to revolve around this, so we'll revisit in a sec. We give you a bunch of reasons why you want to consider a QLAC. Talked about what's not included in Secure 2.0. So there's no effect on the backdoor Roth IRA. They're still okay to do. There's no income limitation for Roth conversions. That was talked about. That never happened. And there's still, believe it or not, no restrictions on IRA investments in startups or privately held stock, which we thought would 100% be on the radar of Secure 2.0, but we were able to kind of withstand the press. So now we're going to get into like planning opportunities and the meat and potatoes of this particular presentation. And we're going to start with inflation. So inflation is really bad at the grocery store, but it's really good for taxes. What that means is that your tax brackets will go up accordingly with inflation. So you can pass a lot more money through these lower brackets because of inflation. In 2025, the tax rates revert to higher levels. So if you listen to Ed Slott and you listen to different industry experts, they call it the 3-year plan. You effectively have 3 years to convert low tax ordinary assets into a capital state or a tax-free state. So we're going to get into some different planning ideas, right? Some of us think that the 37% bracket is rather high. I live in New Jersey at $1 million. Your IRA money is taxed at an additional 10%. So if you think about spending down money in New Jersey at 47.35%, it's pretty egregious. But guess what? If you did that in 1981, it would have been at 80.35%. So tax brackets, I guess you can say, Channing, are on sale.
They are on sale, and it's the 3-year time period right now where they are on sale.
So if you look at ordinary brackets, the top rate is effectively 40.8 for those subject to the 3.8% Medicare surtax on net investment income. But you can pass a lot of money through these joint brackets right now. And you see what inflation did from 2022 to 2023, picked up a $45,000 you got a $45,000 lift in that 35% bracket. So there's some cool things you can do with Roth conversions and spend down. Where I think we get a little sideways is that, like, the RMD mindset, we need to be thinking maximum. The M in RMD is not just minimum. You can also look at this as spending down the maximum, because that window is closing, right? You have this 10-year rule, you have looming tax rate increases. Lord knows what's going to happen with a $33 trillion deficit. So there are big opportunities to spend down these assets and or convert these assets to different tax locations along the way. So, as we get into the solutions here, there's really 3 ways to combat this: Roth, life insurance, and charitable. So again, for the purposes of today, we're going to spend all of our time in life insurance because that's what we do. We'll spend very little time in the other 2, but the slides will be passed along for you to reference. So, if you look at asset and tax location, there's really 3 ways to tax assets. We have ordinary assets, you have capital assets, and you have tax-free assets. We are absolutely obsessed as a financial service industry to do asset allocation. We want to make sure we have enough small cap or large cap, treasuries and corporate, but we pay 0 attention to the location of the asset and the taxation of those assets. Here's a time to convert some ordinary assets to capital or tax-free locations while the income tax brackets are low. So, Channing, just give us a high level. What are the basics of a Roth IRA? And we'll move on from this and get into this life insurance discussion.
Yeah. So, as I explained before, the typical IRA is we're using before tax dollars. And eventually when that money comes out, that's going to be income tax. Well, Roth is almost the exact opposite. As long as you follow the rules, we're going to get taxed when that money comes in. But when that money comes out, now that, as long as you follow the rules, is going to come out income tax free. So as we kind of think about, I love that slide that you had before where we show, the different types of ways that assets are being income taxed. If we can kind of diversify some of the buckets and look at, maybe we have some retirement income, we have some capital assets, but if we can really kind of diversify and put some money over in that tax-free, that's really going to solve a lot of issues maybe for some of the clients here. So that it's after tax dollars go in, it's going to grow tax-free. And as long as you follow the rules, Anthony, you can take that money income tax-free. The sooner you can put that money in and the more that it grows, the better that's going to be when that comes out. And so that is really, I think, a powerful tool as we think about this 3-year time period that we're looking at right now, where inflation is putting up those income tax brackets. So now clients have some money to do, but before the sunset comes in, where those brackets are going to be kind of come down a little bit and they're going to be taxed. This is a good opportunity to look at some of these things, and Roth could be one of them. Life insurance is another one, which we'll talk about soon.
Well said. Well said. Here's my very practical version. Channing, correct me if I'm off base here, but I think you bet the Roth when you have 4 aces. And in my definition, your 4 aces is you don't need the IRA money for 5 years, right? Once you convert, you can't get after those Roth dollars for a period of 5 years. There's a blackout period, which I don't know if a lot of folks understand. So you need other assets to live off of during that time frame. If you believe, and this is a big one, if you believe that capital gain rates will increase, the Roth is a great tool in comparison to the spend down method, which we're going to get into. If you can spend down and invest in capital assets plus tax-free assets, and cap gain rates stay the same, you're in really good shape on the spend down. If you think cap gain rates are going to go up to ordinary type levels, you might want to consider some of your assets be converted to the Roth. If you're looking to avoid stealth taxes and you want to take easy street from this point forward and be able to manage your income tax brackets to much lower thresholds, a Roth is a great tool. If you have other assets that are already producing ordinary type income, that may be counterproductive because you're already going to be in the max tax rate. But again, like you really got to look at every situation on their own. And then number 4 here is, if you have so much love for your children and grandchildren, this is an opportunity to prepay all of their income taxes for the remainder of their lifetime on this particular asset, which is a pretty cool gift to give come Christmas or birthdays, right? I mean, so Channing, now we get to the fun part. As you have written about and spoken about and developed different solution modules through technology, the power of life insurance as it pertains to large IRAs, we believe is now the replacement to the stretch IRA. We look at moving this to the top of the list because life insurance doesn't require you to spend everything out in 10 years. Life insurance with a properly drafted trust maintains control of the asset, right? Life insurance has a tax deferral component to it. You're not hitting the max tax bracket inside trusts. So it becomes really, really attractive in today's world. And, you know, I think you've done a really good job in articulating like 3 decisions an IRA owner would want to make towards retirement dollars. So without stealing your thunder, would you walk us through and the participants through these 3 decisions that they could make?
Yeah, and so these are decisions, and it kind of depends on where your clients are for ages. The first decision here is prepaying retirement income taxes. So this is really maybe something to take a look at for some of your clients between the ages of, let's say, 40 to 60 years old. And, you know, one thing with life insurance is we have to make sure that it's not for everybody. You have to qualify for it. And if you have a healthy person, this could be a really good option. So what this is, okay, we know that we're putting money away in our retirement income bucket, and we're putting those assets in there. We know that there's going to be income taxes when we start taking that money out. So we're doing the plan that we've always done over here with that part of it. With prepaying retirement taxes, we're changing things up a little bit. We know that this person's working, probably has a high income. And so one of the things that they're going to want to do is protect their family. And one of the ways that they can protect their family for income replacement or for legacy planning is by a life insurance policy. Instead of like looking at a term policy, we're looking at more of a permanent policy. And number one, we're protecting the family. So if anything were to happen, the family's going to receive that money the time they need it the most. But we're going to put that money in a accumulation type life insurance policy. And we're going to have a cash value that's growing. And this cash value, very similar to the Roth IRA that we just mentioned, it's after-tax dollars. We're putting that money in. If we follow the rules correctly, we can take money out on an income tax-free basis. So one of the things that with the prepay retirement taxes, and we've got some materials on this, is we're not only funding our retirement asset, but we're also funding this tax preferred asset. And so now when we are taking that money out of that retirement income act and we're getting more, let's say, income taxes when we take that money out as a distribution, we're going to potentially use that cash value of that life insurance policy as taking basis or loans thereafter, taking that out on a tax preferred basis and maybe using that to help pay for some of those income taxes there along the road. This is definitely something for somebody that maybe thinks they may be in a very high tax bracket once they hit retirement with all the planning that they're doing. It's a strategy that really kind of fits some of those younger clients. But the other two are something I think that really hits this presentation, Anthony. The first one is tax efficient legacy. And it goes kind of through the same things that we have already talked about. With Secure Act 1.0, with Secure Act 2.0, one of the things that you noticed is that they're delaying that RMD age to some point in time. And we've gone from 70 and a half all the way up to, let's say, 75. What that's doing is one of the things that clients don't want to do once they hit retirement, they try not to take any assets out of that retirement income because they're so scared of that tax that's coming out. So what's going to happen is we've got these big balances that are coming over, and now they're finally taking money out, and maybe they don't spend a lot of it. And then now that goes over to their kids, and now their kids maybe are in their 40s and their 50s. They might be in the highest tax bracket that they have, and now they've been given this asset, and they've got to take that money out. And this could really put a huge, they're going to have to pay a lot more income taxes, because not only are they getting money from their job or their business that they're running, but they're also having to take money out of this IRA that they inherited from their parents. And it's really going to create possibly a tax nightmare that's there. So what tax efficient legacy is maybe we look at those IRA balances and say, okay, maybe we take a little bit up part of it. Maybe it's an RMD. Maybe it's a distribution that's going to be there. Maybe we'll take a distribution so that we maybe not go up to the next tax bracket, but we'll play that, and we'll work with our tax professional to do that. But we're going to put that into a life insurance policy, and we'll put this in a life insurance policy that we're really going to try to maximize the death benefit on it. And so it's, let's say, the least amount of premiums get the biggest amount of death benefit that's there. And by doing so, these clients are creating a lot of flexibility for their kids. Anthony, one of the things that we talked about was a lot of these high net worth clients, they want to control how that money goes. If it's in an IRA, the kids get it, they got to take that money out. There's no control. Instead, if it's in a life insurance policy and that policy goes over to a trust, now that goes over, the death benefit goes over to that trust. It comes in income and income tax free. Now it goes into that trust. It can be invested, and you can put stipulations. They can control how that money comes out. So it's a really powerful technique, especially for those clients that really want to control that money and how that money is spent. So that's tax efficient legacy. And what it's doing is just making more efficiencies in some of the legacy planning that we're doing. The third option that we have here is prepaying beneficiary taxes. This might be where we look at a smaller death benefit on it. And what we realize is once these beneficiaries receive these assets, this IRA balance, they're going to have to pay the tax. Well, this could create a lot of problems. And so using maybe a death benefit on a life insurance policy, now that's going over to the beneficiaries, they get that income tax free, and they can use possibly those proceeds to pay for that big income tax hit that's going to be there. This is, we see tax efficient legacy more often in a lot of planning that we're doing, but every once in a while, this prepaid beneficiary taxes kind of fit some of the objectives of some of the clients that are there. So yeah, there's some issues here, but there's definitely some solutions as well, Anthony.
Well done. And as I mentioned, Channing not only understands the conceptual uses of life insurance to either give the client a asset or a tool to offset some of the income tax lost in retirement, right? B, maximize the transfer to the family, or C, just replace the tax due that Uncle Sam will take at the high point of the IRA value. And what's really neat, and between the modules that Channing has built and the software that Life Brokerage is using and also currently working on, the math doesn't lie, right? So if you it's often a tough pill to swallow. I mean, we sat across from a 62-year-old man who worked in an ESOP company and accumulated $31 million in his IRA. And I could look him dead in the face and tell him that the optimal strategy for he and his wife and his children was to write the IRS a check for $14 million tomorrow and reinvest those assets in a capital equity type structure, plus max fund, follow me, max fund an option B or a survivorship whole life, whereby the death benefit starts out very low and increases over time through either dividends or interest credits. That was the optimal scenario. Looked at us like we were crazy, but at the end of the presentation, the math made all the sense in the world to him. He was the chief financial officer of this ESOP company. So we're going to get into a few planning ideas here, and this is going to move kind of fast. So one is the spend down, and that's exactly the tax efficient legacy Channing just described. He was very gentle in saying, maybe we'll use an RMD, maybe. Guess what? We've calced this every which way possible. The best way to do this is to spend down your IRA assets over year one. The second best way to do it is to spend it equally in years 1 and 2. And the third best way to do it is to spend a third over the next 3 years before the income tax rates jump on you. So after-tax funds can be used to purchase the life insurance. If a trust is needed, you set up the ILIT, and from that point forward, it would be only fair to assume a much lower income tax bracket in retirement that the do nothing scenario would use. So clients here get to benefit larger inheritance to the family, more control over the asset, and less taxes over the rest of their life expectancy. I just talked about, the optimal way to do this. If the client just can't stomach it, the software that Channing has built allows you to spend it any which way you want. If you feel better spending it over 7 years or 12 years or 16 and a half years or 27 years, it's all inputs. And what you will see is that by prepaying the income tax for the children and grandchildren will create the net result you're looking for. I can tell you this, that I know for sure, because we have tested this every which way possible. Here's the customer I just described to you. We looked at the current scenario. We looked at using the qualified charitable distributions. We looked at qualified charitable distributions and spend over 10 years, 1 year and buy 17 million of life insurance, 1 million and buy 1 year and buy 8.5 million of life insurance, 3 year spend down, 5 year spend down, Roth conversion. It all comes back to the same place. The optimal scenario is to spend it today and make a gift to life insurance. That can be completely up to the customer and their threshold for pain of life insurance. If you can describe to them the benefits of life insurance, it's an added leverage tool which will help the wealth to heirs that they don't have to do, but the math suggests that they should. I would also couple those strategies with some different additional planning strategies, in that you can add a survivorship lifetime access language to that trust. So if you are using max funded IUL or whole life or whatever your product, VUL, whatever your product of choice is, you can still gain access to those funds through your spouse if he or she is still alive. You can also use beneficiary lifetime access. You also look at this cash value component that is trust owned as a buffer to hedge against down years in the market. So you can kind of weave in some of the planning ideas that we've talked about in prior webinars right into here. And what I want to give you in these slides is that you can see how intuitive Channing's software is that will spit out the tax efficient legacy, the prepaying your beneficiary tax, or pre-funding your retirement taxes. Channing, I don't know if you want to spend any time on this, but maybe we can even walk through a case study here where you have your male 60, female 55, and talk through this $1 million IRA balance using the tax efficient legacy strategy.
Yeah, let's look at it. So here's kind of some of the prompts that we put in. You can kind of take a look at it. But let's kind of look over at kind of, and this will just show you all the different ways that you can kind of the prompts you can in the inputs that you can put in there, from the investment side to the tax rate side, the beneficiary tax rate side. So there's a lot of flexibility within the system. Let's take a look at the output. And this is where we have a value client. He's a male 60, female 55. And you can see we have the qualified plan balances right there. And so that first thing, we have year, age, the qualified plan value at the beginning of the year. We're going to add some growth to that as well. These clients have not hit their time where they have to take that money out, the RMDs. So they're not going to take any money out. So there's not going to be any income taxes. You can see what the qualified plan is on the other side. And then we have the taxable account on the other side. And you can see as we're kind of doing this, we are starting to take RMDs out, and now we're starting to get some income taxes on the distribution here as well. So that's the current plan. That's if we do nothing and just leave that money over there.
Right. So the current plan is to sit and take it, right? So
exactly.
Right. So Uncle Sam's going to come in when you least expect him, when your qualified plan balance grows to the absolute highest possible value you let it get to, and then he's going to come hit you. So this is like the slow bleed, right? Like really painful. You're not converting ordinary assets to capital assets until the government tells you so. Well, why you would think they're giving you good advice, I have no idea. But we're gonna make a slight tweak here. Shannon, this slide probably not as necessary, but here we go. Here we go on the recommendation.
Yeah, so here's where we're making that transition. We're going to start taking money out of that qualified plan to now kind of put it into a life insurance policy. So we're putting some after-tax dollars on there, so we're going to have to pay some income taxes on it. So we're starting this on year 1, and we're going to do a 10-pay here, Anthony. And you can see here the premium is right around, let's see, $90,000. So we're going to be taking some distributions out, and we're going to have to pay income tax on that distribution in order to get that premium payment of right around $90,000. So here, that surrender value, that's that cash value that we've been talking about. So if they ever needed to get this money, they could potentially get it. But what we're really circling here is that death benefit. And what we're really doing with this qualified plan is now we're making this death benefit. We went from 1 million up to 3 million. And the big thing about this death benefit, because it's in life insurance, when it gets paid out income tax free. We don't have to worry about the stretch. We don't have to worry about the 10-year rule. That money just comes out income tax free. That's there. And so you can see here the current plan versus the proposed plan, and you can see how powerful that really is. The other thing you can do with it is, like Anthony talked about, we could put it into an ILET for the beneficiaries, or even we could put that in using some SLAT language and use it for the surviving spouse as well. So we're really doing some powerful planning here for the right client.
Just quick shameless plug to Securian. One of, if not the lowest policy charges on an IUL, very responsibly built. One of, if not the most competitive guaranteed VUL, which there are times where we will look at a level death benefit with guaranteed elements, and this is one that will also build a significant amount of internal cash value. They do things really well. So there are two product lines also having a survivorship chassis in the IUL and the guaranteed VUL. If you want to just map the asset allocation to a accumulation VUL, that product is built extremely well also. Number two, planning idea number two. Instead of spending down, which we just described, now we just introduce a Roth conversion to transfer the taxation location of ordinary to either capital or tax-free. So as long as we can illustrate an acceptable comfort zone that the client will not run out of money. Remember that be mindful that 5-year blackout period, and improve the quality of the retirement assets, of course, by exchanging them for more tax favored location, and increase the net to family, then a Roth IRA plus gift to life insurance, also a very good tool. Depending on the assumptions, depending on your belief of what you will do with your outside assets and what you will do with reinvested RMDs, if you didn't do the conversion, will determine which one takes like first, place 1 and 1A in this strategy. And again, we can test this for you through a program called Wealthy and Wise, where we show you the current with IRA, a Roth conversion, and then a Roth conversion with life insurance. We'll line this up with Channing's output on the tax efficient legacy, and we'll determine like what is the best solution for that particular client. Planning idea number 3, I call this the covered asset. So your IRA assets can purchase single premium immediate annuities, and you can stretch the taxation out, over a number of years. Now, you're going to want to do this with more mature clients. Here's where the estate planning trick comes in. The value of a life-only SPIA at death is what, Channing? Zero. So you just eliminated several $1 million from your taxable estate, and you swing it back in through the form of a life insurance trust, where you're taking the cash flows from that particular annuity to create a legacy inside of an ILET. Why has this become more attractive? Well, because the sharp increase in interest rates have made SPIA payments created more leverage for us in the acquisition of life insurance. A male 70 got a 6.8% distribution rate, just, call it what, less than 3 short years ago. Today, that same distribution rate is up about 200 basis points. So you get a lot more bang for your buck, and we have a one-page template that shows you how to transact that. Another strategy, right? We've got some clarification through the Secure Act around immediate income annuities. You're allowed to buy a SPIA you're allowed to buy a 10-year certain in your IRA, and you can convert that asset to after-tax dollars through the form of the payout. And you can use that payout to go out and fund multiple needs, whether it's a hybrid LTC or life insurance, or hybrid LTC on the spouse even, which is also a pretty creative technique that we've been using. And lastly, and this one is far more complex than any others, is that if you can take those IRA dollars, if there is a reasonable and necessary business purpose, convert that IRA to a profit sharing or a micro K or some type of qualified plan that allows the purchase of life insurance inside the qualified plan. You can then spend down those assets through the form of premium, and at some point in the future, have your trust buy that policy from your qualified plan. So don't have time to get into the mechanics of that today, but just know that that's available to you, that a pension-owned life insurance policy can be swapped with ILET assets for a fair market value. And that's a whole nother presentation in itself, but that's planning idea number 4. Real quick, as we're closing in on the top of the hour here, some charitable planning ideas, also very efficient, used in combination with life insurance. We talked about the qualified charitable distribution. You can make direct payments from your IRA to the charity, not have to recognize the income and then take an offsetting deduction. You're going to zero out the net tax effect. Charitable remainder trust. I think we'd be remiss if we didn't spend a minute or two on this. Channing, give us the structure of how the CRT can simulate the stretch and help offset some of the income tax pain of spending down your assets or converting your assets.
Yeah, so a CRT basically is where you create this trust, it gets funded. And so, it's a charitable remainder trust, which means that the end of the day, at a certain term of years or during a lifetime of an individual, what's ever left in this trust is going to go over to a charity. And so during the time period, though, that money that's in that trust would then be paid out to, let's say, a participant or to a beneficiary or whoever that is. What that does in a nutshell is, since some of that money is going to go over to a charity, we do a present interest on whatever that amount would be dialed into going over to a charity. And so there's going to be a charitable deduction there. And so this could be really a powerful planning for maybe a client that wants to not only be kind of tax efficient, but maybe give some money over to a charity as well.
Well said. Well said. There are some drawbacks to the CRT. And again, these slides will be available for you to reference and pass out, not just a recording of today's presentation, but a copy of the slides. So just kind of recap as we bring this to a close.
Could I add one extra bonus one?
Absolutely. Please do.
Okay. In the charitable planning thing, one thing that I've seen recently with some clients is maybe doing that tax efficient legacy. And so the kids are going to get some money, whatever the death benefit is in the life insurance. And one of the things that they're doing is they're putting as beneficiary of their IRA as a charity. And so that money is worth more to a charity than it's going to be the beneficiaries, because they don't pay taxes. And so we're seeing that as a planning tool also. So that was just an extra bonus one, Anthony.
Great point. I do have a question from the audience. When can we take money from an IRA and transfer directly to a charity? So the rule is that you can take $100,000 per year and facilitate that direct payment. In 2014, as a result of Secure Act 2.0, that $100,000 per year will grow with inflation. So we anticipate that to increase over time, but you're capped out at $100,000. So we've answered several other questions throughout the presentation, Channing. So I'd like to just maybe bring this home, where we should be rethinking retirement tax planning for 2023. You have some basic fundamental knowledge of Secure Act now and ability to reference through these slides, but the big ones are money's coming out in 10 years and trust planning no longer works. So we're starting to look at Roth conversions, life insurance planning, and charitable planning. Life insurance, I may be a little biased, has now jumped to the top of the list. At very minimum, identify and contact your clients who are affected by this. Remember, the $1 million IRA and up. Explain the new planning challenges. Consider the Roth will help you model. Encourage the client to look at every single plan beneficiary form and designation, especially when they're the big ones. And then you can start advising on what IRA assets are best to give to charity, how to use charitable qualified distributions, when does life insurance, how will life insurance replace the stretch, give bigger inheritances, more control, less taxes. If you have any questions, we are at your disposal. I want to thank my presentation partner here, Channing Schmidt, for his intellectual capital and time that he spent with me on this presentation. We want to thank the participants for attending. And at this point, we'll bring this meeting to a close.
Thanks, everybody. Thanks, Anthony.
Thank you.